All right, so this begins our sort of final batch of material before the final exam. And as I said in my announcement, the final exam will include the balance sheet and the income statement. And it will also include material from exams 1 through 3. And it's cumulative final. And, in terms of its structure, the only problems that you're going to type responses to on the final will be balance sheet and income statement problems. There will be at least two problems, one with a balance sheet, one with an income statement. I might break one of them up into two separate problems just for manageability, but those will be the only workout problems you'll have. The other problems will be multiple choice questions. And, to some degree, I think it helps to go back to exams 1 through 3, but not necessarily just to study the multiple choice, because the multiple choice I write certainly might touch on the same topics or pose the same knowledge point questions, but they will do it in a different way. There won't be direct replication of questions. And because you're not working problems free form on the material from exams 1 through 3, I'll have a little bit more calculation based questions like, what is bad debt expense for the year if the company has this aging schedule? What is the cost of goods sold using LIFO periodic given this purchase and sales log? What is shrinkage? If the company expected this many units, they found this many units, and this was their purchase sale log. So there will be more calculation-based questions in those multiple choice questions. Some theory concept, but not quite as many as I tend to toss on the individual exams. Um, the other point I wanted to make about the final before I dive into the balance sheet is that I tend to weight a good majority of the final on this new material. So the new material will be about 45 to 55% of the cumulative final, with the exams 1 through 3 making up the other portion of it. So those two topics are really important. I stress them that much on the final because, quite honestly, they are sort of the end product of the accounting process. And, I feel like if you understand them, their format, their use, um, then you've really kind of unlocked what I think people take away from this course. You're not necessarily going to remember how to make an entry under the perpetual system when a customer does not take the discount under a net method, all of that, right? But hopefully we'll remember, oh, I remember that income statements are structured like this, and that this subtotal is more important than this subtotal, and or at least it's more persistent, and those sort of things going through the course. So I want to talk about the balance sheet and kind of, give you a broad idea of what I want you to take away from this chapter. Then I'll discuss a bit about its purpose and the idea of capital structure. And that's, what really the balance sheet is tuned for is a risk assessment. And that's kind of the focus of it. Then we'll look at a couple of problems from the chapter 4 study problems that involve balance sheets. All right, so I'm going to switch over to the dot cam and we're going to talk about the balance sheet. So, really, primarily, it's, you can make a balance sheet all day, but if you don't know why you're making it, what's the point of it, right? So, what is its purpose? The purpose of a balance sheet. And really, what we're getting at is what are the resources? What are the obligations? And by natural fallout, resources less obligations, what is the ownership stake? And of course, each of these refers to one of the big pieces of the accounting equation, A, L, and E. Um, so really we're getting a sense of what is the total dollar value of the company's economic resources? What is the total dollar value of all the obligations that it owes? And what is the ownership stake? Like, what do my owners get to take home at the end of the day when we take our resources and pay off all our obligations? Because that's the net worth of the company. And so this, of course, translates to A equals L plus E. And, when you're really thinking of this, it's a very simple equation, and it really expresses a simple truth of the business is that all resources, all A, so right, all resources come from two sources. So anything of economic value that a company has title to has to come from one of two places. Either the company borrowed it or it was invested. So if you think of any type of flow into the company, it has to come from one of those two places. Well, the company has cash. Where did the cash come from? Did they borrow it from a bank? That would be a liability. Did I, as the owner, put my own money into the company? Well, that's equity, right? Did we sell stock on a public market to thousands of investors? They are now owners of our company because they gave us money to invest in assets or to pay off liabilities, right? Bank loans, bonds, obviously liabilities. There's other tons of other things in there. Now, I write this equation not to point out the purpose of the balance sheet. This is just an economic truth. Some intro students come into intermediate with a sort of naive idea that the purpose of the balance sheet is to establish that assets equals liabilities plus equity. But there's no need to establish what is just simply an economic truth. It is just the truth of businesses that all the resources we have title to, all of the economic resources or expected future economic benefits either come from borrowing or from getting investments from other owners. And so, while this is true and while it is useful to us, it is certainly not the purpose of the balance sheet. The purpose of the balance sheet is a little bit more about the relationship between assets, liabilities, and equity. And so, for example, if you think about this truth that A has to equal L plus E, then you get you can represent it visually by saying, all right, well, here's all my assets. And if this area, if the area or the height, the area is obviously off because of how I drew it, but the height of this is equal to some mixture of liabilities and equity. And so maybe we have a company, and I don't know how much this is, but say assets are at 100% and my liabilities are, say, at 30%, and that means 70% equity. Well, that's a very different company in terms of capital structure from a company where we have the opposite be true, where we have all our assets on the left side, and that's 100% in terms of dollars, right, or what have you. And we have, say, 30% equity funding those assets, and the other 70% of those assets are funded by borrowing. And these are very different capital structures for companies. This would be a highly levered firm. We would call that highly levered because they have a lot of liabilities, which are also known as leverage. This is a low levered firm because it has relatively few liabilities funding its assets. Now, highly levered, low levered, right? Is it good? Is it bad? Okay, there are some inherent issues with a highly levered company. It's riskier. Why is it riskier? Because if it's funding this much of its operations with liabilities, liabilities have to be paid off. They are obligations of payment. We have to sacrifice future economic benefits or assets in order to pay those off. Interest, in particular, interest on loans can bankrupt the company if it gets bad enough. Now, in real life, company, the people who let companies borrow money are not going to force the company into bankruptcy on its first missed interest payment because it's probably not going to get what it wants out of the company. Really, it's in the interest of bondholders to just have the company survive and continue paying interest. So, but nonetheless, there is the right for a company who has taken on too many liabilities, cannot pay interest. They may eventually need to seek bankruptcy, and that creates a lot of credit risk. Low lever companies are less risky from a credit risk perspective, but have more diluted ownership. And what does that mean? So basically, what that means is if I buy a single share of stock, let's say that, take percents out, say that we have $1 billion of assets, 300 million are liabilities, and 700 million are equity. And the same's true here, except in reverse. 700 million of these are liabilities, 300 million are equity. It would take a much larger equity investment on my behalf. If there's $700 million of equity floating around, it would take a much higher investment in terms of buying stock for me to get a 10% ownership in this company than it would for me to get a 10% ownership in this company because there's far more shareholders in a 70% equity company than there is in a 30% equity company. And so that additional shareholdership dilutes ownership to the point that, oh, it might have taken X number of shares in this company to get 10% ownership of it. Whereas it'll take, at least a little over twice that in order to get 10% ownership in this company, just going strictly by the percentages. And so we can capture an idea of how the company is funding its assets by the relationships between assets and liabilities, assets and equity, liabilities and equity. All of those things tell us a certain perspective on the riskiness of the company. There's a further breakdown of risk in the balance sheet in terms of its formatting. We have both current asset, we must designate current assets, current liabilities, non-current assets and non-current liabilities, or long-term, if you will. Non-current and long-term are the same thing. I just noticed a trend in switching to the use of non-current in the past like 4 or 5 years. I'm not sure why, but and they do this because these guys are either assets that are going to pay us their economic benefits within a year or be used, or obligations that we're going to have to pay off in a year. But both of these happen essentially most of the time within a year. We either expect money from assets or payment on liabilities. So we're either bound to get some cash from our current assets within a year, or we're bound to pay some cash in getting rid of some of our current liabilities that will come due within a year. Whereas these are longer than a year. Now, I said sometimes because it depends on the operating cycle. If a company has an operating cycle that is longer than a year's time, then that defines the time element. So if I have an operating cycle that's 2 years, then it's all my current assets are those assets I am going to convert into cash or use up within the 2 year operating cycle. Same with the liabilities. Those are all the liabilities I have to pay off within the 2 year operating cycle. So when the operating cycle is longer than a year, that becomes our designation of current versus non-current assets. And an example there's not a whole lot. Typically, companies with operating cycles longer than a year would be um, probably defense contractors, um, certain commercial real estate, or really even beyond that to like um, companies that are involved in the construction of high-rise buildings in downtown areas, projects that are going to take from start to finish longer than a year. It could also apply, an operating cycle longer than a year to a real niche industry like for example, Tiffany's. I would imagine jewelers, artisan jewelers, have inventory that has sat in their shelves for longer than a year because, this ring is going to cost somebody, let's say, $70,000 to buy. Then you're probably going to be waiting a while to find the right person for this particular ring to move off your shelf at 70,000. And so it doesn't have to necessarily be this huge ongoing project. It just basically if we're retailing on a longer than a year operating cycle, it's very long turnover of inventory because of how special and expensive and niche it is. So all of this usage in terms is again going back to the idea that we want to figure out risk. For example, non-current liabilities tend to be less risky than current liabilities simply because we have longer to pay off our non-current than our current liabilities. Current assets tend to be less risky because we expect to convert these into cash or use them sooner than we do non-current assets. So we have a series of ratios that kind of investigate that it is good and that you should be familiar with. These aren't hard to remember, they're not hard to memorize. They all follow a similar pattern. We look at a couple of risk aspects, liquidity being one. Liquidity is short-term risk. Ooh, don't need the Y there. Short-term risk. And how we measure liquidity, we can either use a current ratio, which is simply the current assets divided by current liabilities, or we can use what we call the quick ratio. And nothing changes with our liabilities. So we still throw all the current liabilities in the denominator. But in the quick ratio, we restrict the assets we include. We only want what are termed the quick assets. So we want the cash and equivalents, because not all cash is pure cash, but some of them are equivalents. We add in any short-term investments. In this chapter, I'll be calling them marketable securities, which is just another name for short-term investments. And we also include accounts receivable at its net or net realizable value, right? We want to make sure we subtract off the allowance for doubtful accounts. So between these two, we have an aspect of the company's liquidity. Now, when we're thinking about, well, how's the quick ratio different than the current ratio? All you have to do is provide the properly formatted current asset section. So you'll start off with cash and equivalents. You move into marketable securities, our short-term investments. Then we are listing our accounts receivable at their net realizable value, net of the doubtful accounts. Inventory is next, and other current assets are the final one. These are ordered in order of liquidity, and these are the designated current assets that all companies tend to have some of each, and there has to be a total at the bottom. Like that's something because we want this total current assets to be a sort of highlighted piece of my balance sheet so that people can run these liquidity ratios. So what's the difference between the current and the quick? Well, the quick only takes the first three, the ones that are the most liquid, and those are our quick assets. Inventory and other current assets are excluded from the quick ratio. They are included in our current ratio. So if you're analyzing a company, yeah, it might have a great current ratio, but if its quick ratio isn't quite as good, then what that indicates is the company must have a lot of assets in inventory. If its current ratio is fine, when we include all the current assets, they're doing well. It's over one, let's say. They have more current assets than they have current liabilities. That seems like a good indication. If we then turn to their quick ratio and we see something less than one, well, what that means is that inventory and other current assets must have been making up a bulk of these current assets. But when we look at their quick assets, they might not be as well off. So those are just the short-term ratios. The long-term ratios aren't much different. When we talk about liquidity, that's short-term risk, then we can also incorporate a discussion of solvency, which is longer-term risk. And there's two more ratios to consider. Very analogous to, they're just analogs of what we see up here for the liquidity of the current ratio and the quick ratio. When we're looking at long-term risk, we're looking at not just the next year, but the years that follow. And so it might make sense that we turn to a total assets to total liabilities. We're very inventive with names in accounting, um, which is just very much literally describing the fact that I take total assets and then divide them by total liabilities. So that's a solvency. This is telling me more about, is the company not just going to perform over the next year, but is it going to perform for the years that follow? And then the other sort of solvency ratio we get into is, I mean, there's a couple different ways to that people capture it. I'm going to take a little bit of a finance spin and talk about the leverage ratio, or how the company is levered. And that tends to not actually involve liabilities, but is at total assets divided by total equity. I mean, analogs of this one could be, and I think might cover this in the videos, I forget. You can look at debt to equity, which would be basically total liabilities to total equity. So we got a host of different ratios. And like I said, the balance sheet's purpose is not about just showing me that assets equal liabilities plus equity. Investors expect that. I mean, if we have an issue where assets don't equal liabilities plus equity, that's screamingly bad, right? Because that clearly shows the audit process failed. The internal accountants don't know what they're doing, and the SEC didn't catch something very obvious. So we are pretty sure that assets equal liabilities and equity. What we're interested in is the relationship between assets, liabilities, and equity to learn something about how risky this company is and how that risk might have changed slightly over time. So the purpose is huge. Definitely want you to know what the purpose of it is for both the income statement and the balance sheet. That'll certainly, definitely be a multiple choice question I ask. Beyond that, I want you to know the formatting. Um, Now, I won't ask you necessarily for a full balance sheet that is properly formatted, but I definitely have asked for a properly formatted current assets section or a properly formatted property, plant, and equipment section or something along those lines. But it's a good exercise to know, for example, first are the current assets, and I won't bother to rewrite them, all of them, because they are right there. But if we think about beyond that part, so I'll just write here, current assets, and then all of that fills where I'm putting the dot, dot, dots. And then, of course, we need to have our total current assets balance to indicate what we have. Right after current assets, the next most common major category is non-current investments. Then after that, I'm going to leave a little space just to put some additional pieces in here. Then after that come property, plant, and equipment, PP&E. And then after that come intangibles. And if there are any, we have also other non-current assets. So ones that don't really fit within any of these categories, right, kind of go here. We also have, of course, that other designation in our current assets as well for those that are we're going to use up within a year or we're going to turn into cash within a year, but they don't quite fit. So there's not a whole lot we've studied. These other categories are a bit ambiguous. There's not a whole lot that we've studied that would go into other current assets offhand. Prepaid assets or prepaid expenses, which are the different ways of saying the same thing. Those would go into other current assets. If we had, I usually don't do a supplies account on my exams, but those would also be, office supplies, whatever. Those would be other current assets as well. Cash and cash equivalents, we've talked about, of course, marketable securities. We're going to talk about that a little bit more, some of the different types of investments. We've definitely hit accounts receivable and inventory. So when you're going through and kind of figuring out, all right, do I have all of the skills necessary in the balance sheet? What is super important is that not only do you know the format of this, because all of it is in order of liquidity, as close as we can get it. And remember, liquidity is an indication of how quickly something can be converted from its current state into cash. And so it helps me not have to memorize, but just appreciate the fact that investments, there's a market for these things. I can sell them pretty readily. There's a lot of people ready to buy them. Property, plant, and equipment gets a little trickier, right? Maybe you have equipment that is easily sellable, but maybe your equipment is so highly modified and so unique that you're going to have a hard time offloading it on somebody. Land can be sold pretty well as long as there's no encumbrances on it or as long as you don't have a huge factory on it. But that can be a problem, and then plants like factory buildings in general, those are tough to sell to people. So these become a little harder to be liquidated. Intangibles become even harder to sell because this involves intellectual property. And, depending on the intellectual property in question, this would be far more unique in niche than our PP&E. Other non-current assets aren't necessarily the least liquid, but they are just the sort of catch-all category that we toss in at the very bottom. And then after we've disclosed all our other non-current assets, then we come to total assets, which would be all, of course, all of our current and all of our long-term assets added together. What are some of the things that go into non-current investments? Non-current investments can include available for sale securities. We'll talk about the three designations of securities next. That'll actually be more probably beneficial than working a problem right off the bat. And then we can work one when we probably still have some time. Held to maturity securities. So what are these guys? Quickly, and then we'll peel back some more layers in a second. These are investments in other companies' debt. So they sold bonds on the public market, and my company bought some of their bonds and then classified them as either available for sale or held to maturity. Other things that can end up in this, and I ran out of room, of course, but other things that can be non-current investments. Land held for speculative purpose. So when we talk about speculative purpose in a business setting, we're basically saying that if we're speculating, then we have an eye on the value of this asset. We bought this land not to use it, because then it would be property, plant, and equipment. No, we bought this land so that we're hoping, because we have a hope or an expectation that its value will increase over time, and then we could offload it and sell it just like an investment, right? So that is a special type of land that is not PP&E. Other non-current investments, this would include long-term or non-current notes receivable. So we talked about notes receivable, but only current notes receivable. They can have, of course, long-term versions of that. And also, finally, sometimes restricted cash can end up as a non-current investment. And if you recall, kind of dig back, restricted cash is when we have some amount of cash that is legally restricted such that it cannot be spent until whatever restrictions are on it are lifted. And in the case of non-current restricted cash, that means that the legal restrictions are going to be in place for at least a year, like beyond a year, right? So that becomes a non-current investment as well. And I don't think there are any other non-current investments off the top of my head that are very common. Usually on a balance sheet, on a corporate balance sheet, these are all combined into one value and just expressed as one value because the investors in companies don't necessarily need to know the breakdown of all your non-current investments. There are, of course, footnotes that will break these balances, that one dollar value they give you for non-current investments into separate categories. Property, plant, and equipment. I mean, the usual are pieces here. We got land, buildings, equipment. Do remember that for this one, there is a contra asset to consider. And just to highlight it and put it in a different color here, we need to remember accumulated depreciation. Remember that accumulated depreciation is a negative, right? Because it's a contra asset. It's reducing my property, plant, and equipment by the total accumulated depreciation of the buildings and the equipment. Let me think. Other things in here, furnishings could be property, plant, and equipment. And machinery, of course, is just another name for equipment, those sort of things. The big key for this category that I want you to remember is that PP&E must be currently used. If we have retired a piece of equipment, um, or a building or land, we're not using it anymore, it cannot be in property, plant, and equipment. It has to then move either to other non-current assets or other current assets, depending on whether we plan to sell it or not. If we plan to sell it, well, if we're planning to sell it, then it becomes something we're going to liquidate within a year. If we're not planning on selling it or can't within a year, then it's an other non-current asset. Same idea with intangibles. They do have to be currently used, although that's not necessarily as much of an issue as it is with the PP&E. But intangibles tend to include patents are a big one. Goodwill is another big one you'll see on many balance sheets, many places. Copyrights, any other licenses to use any sort of, because basically patents and copyrights are licenses, but any other sort of licenses, software licenses, things of that nature could be considered an intangible. Customer lists are considered an intangible asset, right? Just things that are don't have physical substance that tend to provide an economic benefit. Like, yeah, our customer list, the people who buy things from my company. Also, production backlogs is another uh, intangible that companies just produce over time. Like they know what items they have that get backlogged a lot. That's useful information for economic resources. Who to sell it to, useful information. Patents, right? The exclusive rights to a process or ingredients in a product. Copyrights, exclusive access to the reproduction of artistic works. Licenses for almost anything. Goodwill, that one is a very specific type of intangible. I won't get too deep in it, except to say that it arises from mergers and acquisitions. So if you see goodwill on a company's balance sheet, That means it has merged or acquired another company since its existence. All right, man. So we got a lot of filling out here. The ordering within these sections doesn't tend to matter in terms of listing them out. The one place where order always matters within a major category is the current assets. So you got to absolutely know those five in lockstep progression because, again, what they're indicating to us is an order of liquidity. Ah, stupid. No, that one's good either. All right, there we go. One that writes order of liquidity. And this is order of decreasing liquidity, of course, because cash is the most liquid asset. But we need to know that in lockstep. Then it's just about knowing the major categories of assets. So, of course, current assets is a major category, it comes first. Non-current investments is another major category, tends to be the next in terms of the major categories. Property, plant, and equipment to intangibles, and then finally this other non-current assets. And you don't have to worry about what's in that for now. The only example I can give you is the one that I already gave in terms of this is PP&E that is retired from use, but not held for sale. Because if we hold it for sale, then the idea is that it needs to be gone within a year, in which case it's no longer non-current, but becomes other current. All right. So that's and the asset section is definitely the dirtiest in terms of all these different pieces that can fall out there.